What makes more money, a rent house or a note? Stay tuned. Welcome to this week's edition. This is episode 209 of NoteSchool TV. And today we are doing a lesson for you guys. So I'll bring Mr. Eddie Speed on in just a minute. But before I do, let's take care of a little bit of housekeeping. Make sure and like this episode. Yep, go ahead and like it. Make sure and share it with everybody you know out there. And then number two, if you haven't subscribed to NoteSchool TV, make sure and go ahead and do so. And then number three, make sure and hit that bell notification. Yep, bing, so that you will be, made aware of when we are going live every week, which is Wednesday at 11:05 Central Time. Also, one more thing, make sure and send in your comments and questions. We love to hear from each of you. And if you would love to hear more about what we do at NoteSchool, simply go to noteschool.com/TV. Again, noteschool.com/TV. With that, I am going to bring on NoteSchool's founder, our chief visionary officer, all around great guy, Mr. Eddie Speed.
Good morning.
Good morning, Eddie. How are you?
Well, we are going to have a good time today. We are going to take our listeners on what we call our deal lab that we did earlier this week. And we're going to just show them what it looks like for our members to really look at a note and really compare, Joe, okay, if I had X amount of dollars, would I do a rent house or would I do a note? And we're going to talk about that and what that looks like. And I think it'll be, I bet you it'll be enlightening, and I bet it might be informative.
I would take that bet, because it will be both enlightening and informative and profitable.
So let's pull it up. We are duplicating for you guys today what we do with our members, like literally every Monday. Like we're going to just show you. So here's how this works, guys. We're out there in the marketplace and we buy loans every day of the week, right? We're working on portfolios. I worked literally with our trade desk earlier this morning, and we're working on, probably six portfolios right now. So these guys don't necessarily that own these notes. They don't own one note. They own a package of notes. Mm-hmm. And so then we take those notes and then break them down and then make them available to our members like on a one-off basis. Joe, we buy them by the case and sell them by the bottle.
That's right. That's exactly right. Yep.
And so this is a typical asset. This is in Dallas-Fort Worth. And so we just thought it would be a good example of like kind of breaking down what it is, kind of the risk variables, the make sense variables, the math variables. And Joe, we're just going to cook this pie right now, right?
Absolutely. And Eddie, this is a great operator that is in the house business. And it was completely remodeled back when the note was originated back in 2022. And I love it. It's a great little house, completely redone. And it has that, Eddie, I'm going to do the air quotes, the cabin feel to me. I like the green, right? I like that.
Yeah. This guy obviously sells to a big Hispanic clientele. Yep. And you can see there's, Joe, as you heard me say a million times, there's roses in the flower bed.
Yes.
Right? This is their home. Yep. And it means a lot to them. So the current market value on this house, so it sold in June of 22. Okay. The buyer, a couple of credentials. The house is now worth $185. Okay. So it's gone up in value. So Joe, they owe $130. See, they owed almost $153,000. And you're saying, well, it doesn't make sense, Eddie. It was originally 20 years and now it's only 156 months. Yes. You know why? Because they paid down the loan. They paid their loan down earlier than they promised.
Exactly.
They've made
an
additional
extra
principal reduction. So the remaining term is only now, Joe, like 14 years.
Yes.
Right. Whereas, so they hadn't actually technically paid 6 years, but they're paying their loan early, and that's what we see. A lot of equity in this loan, Joe. They owe 130, and the house is worth 185. So if we really ran an analysis over here and kind of drew a little picture of the house, so to speak. Whoops, wrong slide there. Let's see. Let me get the right color. And so if we just do a little analysis here, Joe, of the house, they owe, and this is kind of typical of how we show the students, right?
It's exactly how we show the students, and
they owe 130.
130. Yeah.
See that coloring inside the lines, Joe? You see me practice that on a regular basis, don't you?
Well, a little more lately now that we've got more grandkids, right?
Yeah. So they owe 130, right? But Joe, everything above this
is equity.
Yeah.
Yeah.
That's $50,000 worth of equity.
Yeah.
And so that is a risk factor, because we'll mark how much. They got 50K in equity.
Yeah.
All right. The other redeeming factor, of course, is the fact that they bought it and they have good credit. Good credit. They paid 10%.
Yeah, and their loan to value 70%, Eddie. So they've got 50 grand, 70% in equity.
Well, they bought it with 10% down, and then now they've paid the principal down another 20, and that had some lift in value too.
Yes.
The other thing, Joe, is this note cost $125,000.
Right.
Right. So you're buying it at a discount, and it cost $125,000. But Joe, for your $125,000, you are. I'm going to use a color here. Hopefully this will come out a little bit. Joe, in cash flow, you're getting. You know what? I'm not going to use that color because it's not going to be kind to me.
Yeah.
This one will.
Yes, it will. There you go.
In cash flow, Joe, in 5 years, you're getting $93,000 back of your $125,000 investment.
So you're getting almost 75%, right?
In the first 5 years.
Yes.
So this is what we call a cash flow model. This loan really cash flows really well. So it's an excellent loan from that perspective.
Yeah.
And it makes a lot of sense to do that. And you know, Joe, and you know, it's a pretty solid yield, right?
And Eddie,
the yield on this deal is 11.5. People, that's country club bragging rights, Joe. Everybody wants to know what's my yield.
But Eddie, doesn't, as if they continue to make those payments, those advance payments, that makes their yield go up a little more because they're getting that money back a little faster, right?
Yeah, it's going to accelerate when you get paid. It'll cut off some of the interest, but it'll make your yield even go higher.
Yeah.
And Joe,
that's a great deal, by the way.
Here's what I would say is, this is what you make. This is what you put in the bank.
Yeah.
Right here, right? And this is just the first 5 years. Okay. So I thought I would just take, Joe, this analysis, and let's really break that down. So the payment is $1,557, right? Now I'm not going to write that every month, right?
Right. It's $1,557, correct.
Okay. But everybody kind of gets the point that the slash mark represents effectively 156 payments. Whoops, 156. Eddie. See, these people are learning what the deal loves, right? I miswrite something sometimes, Joe.
Well, we do, you know, it's just one of those things.
Okay.
We are human, right?
But here's what I wanted to show. Let's go take this amount of money right here. And Joe, just for literally for the first 5 years, right? So this is 5 years, and you're getting back $93,400 $411.
Yeah.
And you paid for the entire note $125.
That's it.
125, 800 or something.
820. Yep.
Yeah. We'll round it off. I think everybody gets the point. But see, now you're getting, what was the percentage, Joe?
The 10.8.
No, the how much of your money you getting back in the first 5 years?
Oh, you're getting about 72% back in the first 5 years.
So you're getting 72% of your money back. And then, Joe, just think about the fact that you're going to still continue to collect all of these payments at $1,557. This just shows you a window. Joe, if you bought a rent house, would the math even be close to this?
No, absolutely
okay,
not.
Well, literally, if you paid cash for a rent house, if you bought this house for $185, not $125, but you bought it for $185, okay, that house would rent for about $1,500 a month.
Yeah.
And you would net 50% of that number. So if you paid $185,000 on a rent house, Joe, then you literally could get back $750 a month. Look at this comparison.
Yeah.
Rent.
Yeah.
And a note. So cost is $185. And then the cost here is $125.
Right.
Cash flow would net you 50% of $1,500.
Yep. About
net income of $750 or income of $1,557.
Yeah.
So you pay 2/3 of the money to get double the cash flow.
Right. Right. So you got to look at it, that if everything goes great, you'll get $45,000 as a rental if you get that money, right? And this way we're getting $93,500.
That's pretty easy math, isn't it, Joe?
That's pretty easy to see. Yes.
Okay. So, Joe, this is buying the whole note and just keeping it.
Yes.
The other thing that we can do is we can take this note and we can sell a partial.
Yes.
Okay. So I'm gonna go to another screen. Okay, and I'm gonna pull up the partial, and we're gonna build this out just like we really do in the Deal Lab every day, Joe.
Yeah.
Okay. So I'm gonna switch screens. Okay, Joe.
All right.
We'll enter the terms in here. This is our Excel spreadsheet where it calculates partials. What's the balance on the loan, Joe?
Balance on the loan is $130,229. Note rate is 10.8. And there is 156 payments remaining.
Okay. And then so the term bought, if you sold a partial, I'm going to say you could sell it at a 7 yield.
Right.
Okay. I'm going to play with this, and Joe, and I don't know this.
Right.
But I'm trying to come up to kind of close to what the note cost.
Right.
Let's say 100 months.
Yep. It's going to be pretty close.
And I'm going to go 110.
Look at that.
I should start doing this for money, Joe.
Yep, that's for sure. Look at that.
All right, look at that partial. So this then shows you, the blue is literally you recouped all of your money.
Right.
And Joe, in this scenario, then you got the loan back. And the orange is $1,500 a month for
$1,557 a month for 46 months.
46 months times 1,557 is
a lot.
70 grand.
6 times 1,557, $71,622
for no dollars invested.
For no dollars invested. Yeah.
Now, Joe, What if I wanted to keep $20,000 of all my own money in it?
Yes, that's
and
right.
Sell a partial. So let's shorten up the yardstick now, and let's sell about 7 years.
84 months. Yep.
I got pretty close again, didn't I, Joe?
You did. Then we would have what about
that's 20,000 invested.
Mm-hmm. Yep.
And look at now with 20,000 invested, then what did I sell? I sold 88 months, right?
Mm-hmm.
Then all of a sudden, Joe, I get the note back, and I'm all of a sudden, bam, I've got a partial. So let's lay that out on a chart.
Yeah.
So I'm going to stop sharing. I'm going to go back to my PowerPoint. Okay. Our producers today is making this happen for us, Joe.
That's right. He's pretty sharp. Yeah.
All right, Joe. So this is where we left it on the PowerPoint.
Right.
And now we got a blank sheet of paper.
We do.
Okay. So we're going to come in here and we're going to say we're getting 1557. Everybody knows how it works.
Mm-hmm.
Okay. 156 months.
Mm-hmm.
Keep wanting to write 160, don't I?
Yeah. Yeah.
Here we go. So 156 months.
Right.
And then I'm going to write one more just so we remember what our payment is. And Joe, now I'm going to come in and I paid for the entire note.
125,820.
Yeah, let me find the right color here. I paid 125,820.
Mm-hmm.
So Joe, now I want to sell enough money to pay for the entire note.
And I think that was 110 payments. Right.
Now, Joe, I have no money invested.
Yep.
And I own
46 on the back end.
I have no dollars invested. And then I own 46 payments.
Hey, Eddie, right? I'm going to ask the age-old question there that a lot of folks ask. What kind of return are we getting over there in the green?
Yeah, after I get the note back and I have no money invested, what's my return? I'm going to call it really high, Joe. Yes. It's a really high return.
We always get that question. We always answer it the same way.
So this is the partial.
Mm-hmm.
And it just shows you financial modeling. Now, if you are doing this in a retirement account, you're going to actually need to have some money invested.
Right.
$1,000, $1,500, something like that. Right. Now, Joe, the second scenario that we did,
we left a little money in it.
We left a little money in it, and we
sold. I think it was 84 payments, Eddie. And that would have been for $103,000.
So 88 months.
Mm-hmm.
And so then we come over here, and what we now do, Joe, is we now own more of the note.
Mm-hmm.
And then we have some money invested in it. We have about 20 grand invested.
20 grand. And we've got 68 payments of 1557 remaining, which is $105,876.
How many payments were remaining on that second one?
68.
And how much was it? 105?
105,876 to be exact.
So now all of a sudden we're saying you get your money back in 7 years, less than 7.5 years, and you get 1557 back.
Right.
And so you earn 5 times your investment and start earning a cash flow. And so the reason we show this, guys, is pretty simple, right? 1557 there. The bottom line is this is why notes have so much potential, whether it's cash flow or whether it's owning the rest of the note. I mean, it's crazy as to how much money it can produce.
Yes.
And this is why people that come to Note School start down this road with us, and they start seeing it. So this is a real note, a real asset that was sold this week to a member. And we just simply got on the deal lab with them and we laid it out and we said what was possible. Now, I don't know the student that bought it, like maybe they wanted to keep the cash flow or maybe they wanted to sell the cash. Like it's their chalk and their chalkboard, they get to decide.
Yeah.
Joe?
And, you know, Eddie, if you were to keep this, you'd have your entire investment back in 80 months. And then you've got, what, another 86 months at 1557.
Yeah, at 76 months.
76 months, yes.
Yeah, so it's like, what do you want? Are you trying to replace your income? Are you trying to use it for a crazy wealth building strategy? Yeah. You get to pick. Joe, big thing here is here in a couple of weeks, we got Note Expo. It is notexpo.com. We'll put the link in there. We're going to talk about these type strategies at Note Expo. If you're interested in this, if your rental properties are dragging you down, or you're looking to invest in something and you're saying, I want something that has the most return and the least headaches,
right?
Notes are going to be the thing, right? So you guys, we are so glad that you're listening to this. Come hang out with us at Note Expo. We're going to talk about a lot of modeling techniques like this and how they work. And we're going to talk about, you know, like, do they really work and how do they work and what it takes to make it work. And we got a whole 2 days worth of the best information in the business about something that we've been doing for a long time. And we want to give you a compression of time. We want to make it quick for you to learn a long lesson. And we think we can do that and show you the fastest lessons. Some people, our students, like the fact that we help them go find deals like this. They don't have to go search for them. Yeah. They don't have to go put them together. We put them together for them and kind of, let's just call it, put a ribbon around them, Joe, and they can buy assets like this.
Absolutely. So, Eddie, on November 8th and 9th, Note Expo is the hottest ticket in town, Dallas, Texas. We'll see you then.
Bye-bye.